Welcome back to the deep dive. Today, we're getting into term life insurance, but we're going way beyond the basics. We are digging into the fine print, the mechanics that really determine your financial future.
And that's such a critical point. Most people, they just focus on the length, a 10-year term, a 20-year term, and that's it.
And they think they're done.
Right. But what happens on day one after that term ends? Our whole mission today is to make sure you understand two absolutely essential provisions: renewability and convertibility.
Okay.
These are the clauses that decide everything. They determine if your policy is still a useful tool or if it becomes a huge problem when your health inevitably changes. You need to get this so you're never blindsided later.
And our sources today are great. They're full of specific definitions, actual cost comparisons, and some really vivid examples. We're going to talk about people like Henry, Prina, Jeanette, and Patrick.
And their stories really show why these subtle differences in policy structure can be worth thousands and thousands of dollars. And of course, peace of mind.
Okay, so let's start with that first big choice. The fork in the road, really. Continuity. When that term is up, do you have the option to keep the coverage? This splits term insurance into two main camps: non-renewable versus renewable.
Non-renewable is, well, it's the simplest, it's the cheapest product you can buy, but it also carries the biggest long-term risk for you.
Because it just stops.
It just stops. The policy expires, and that's the end of it. If you still need coverage, you have to start the entire process over. A brand new application, full medical underwriting, everything.
So if you got sick at any point during that last term, you're now applying as a high-risk person.
Exactly. Your health has declined, so you're facing much higher premiums,
Mm-hmm.
substandard rates. Or you could just be denied coverage altogether.
Yeah.
It is truly term insurance in the most literal sense. It ends.
Which brings us to renewable term. I've heard this called the comfort blanket of term insurance.
That's a pretty good way to put it, yeah.
Mm-hmm.
A renewal policy guarantees you the right to renew for another term. And the key is you don't need any new proof of insurability.
None at all.
None. You could literally be in a hospital bed on the renewal date, and the insurer still has to offer you that next term.
Wow. Okay, that's a huge transfer of risk to the insurance company, which tells me it has to be more expensive up front.
It is, absolutely. The insurer is taking on the risk that they might have to keep covering someone whose health has gotten significantly worse. They bake that risk right into the price.
And this is where the Henry example comes in.
It's the perfect illustration. Henry buys a 5-year renewable policy at age 30. He's in perfect health.
And things are fine for a while.
Until he's 38, and he gets a cancer diagnosis. 2 years later, at age 40, his policy's up for renewal. He just exercises his guaranteed right to renew.
And his premiums.
They go up, sure, because he's 10 years older. But that new rate was already printed in a schedule in his original contract. The cancer diagnosis was completely irrelevant. They couldn't deny him, and they couldn't charge him more for being sick.
That guaranteed safety net is really what you're buying. But it gets even more detailed, right? Because even inside renewable policies, there are different ways the new premiums get calculated.
Yes. Let's look at the standard one first. That's renewable with guaranteed rates.
Yeah.
So with this model, the new premiums go up because of your age, but the key is that you get a full printed schedule of those rates when you first buy the policy.
So there are no surprises. You know exactly what you'll pay at 40, 50, 60, no matter what. Karina's example shows us really well.
It does. Prina buys a 5-year term at 25 for, let's say, $155 a year. She gets that schedule. She knows her premium will jump to $170 at 30, then $230 at 40, all the way up to maybe $610 by the time she's 60.
And that lets her plan.
Total stability. She can budget for it, keep the coverage until she's 65, and never worry about a shock increase.
Okay, but there's this other structure. It almost sounds like a gamble. Reentry term with adjustable rates. What is reentry?
It's a classic risk-reward trade-off. And you really have to read the fine print here. A reentry policy gives you 2 different rate schedules.
2.
Yep. You get a super low initial premium, and you get to keep a lower rate if you can re-enter. That means you have to prove you're still in excellent health at renewal time.
So you have to pass a new medical exam.
Pretty much. A reassessment. If you stayed healthy, you get the best possible rate for your new age. But, and this is the huge caveat, if you don't prove good health, maybe you develop diabetes or something, you can still renew. It's guaranteed.
Right.
But the guaranteed renewal rates in that reentry policy are set way higher than in a standard renewable policy.
Wait, so you get punished for getting sick?
In a way, yes.
Yeah.
The trade-off is you get that super low initial premium. You save money for the first term. but you're accepting part of the future risk. It can be a great deal if you only need coverage for a short time or if you're extremely confident about your health. But for a long-term safety net, it's risky.
That makes it much clearer. Okay, so we've been talking about extending temporary coverage. But what if you realize halfway through that you actually need coverage for life? That's where convertibility comes in.
The conversion option is, for a lot of people, the single most important feature for long-term planning,
Why is that?
because conversion does not require new proof of insurability. This is the ultimate lifeboat. If you develop a serious illness cancer, MS, a heart condition, and you're now uninsurable in the open market, this is your only path to lifetime protection.
And like renewability, that protection has a price. Convertible term is more expensive.
Of course, the insurer knows the people most likely to use this option are the ones whose health has gone downhill. It's what they call adverse selection.
Let's look at the example with Anya and her daughter, Jeanette.
Perfect case.
Right.
Anya buys a convertible policy for her teenage daughter, Jeanette. Why? Because a rare medical condition runs in their family. It has about a 25% chance of showing up after age 30.
So if Jeanette develops that condition,
That conversion option guarantees her the ability to switch to a permanent whole life policy, no questions asked. Without it, she'd be completely locked out of the insurance market for life.
that's powerful. Now, the legal side of this is fascinating. You said the new permanent policy isn't a new contract. It's an extension of the original one.
Which is a huge, huge advantage for the policyholder. It means key legal clocks are not reset. We're talking about the 2-year contestability limitation and the suicide exclusion clause.
Okay, break down the contestability limitation for us.
The insurer gets 2 years from the day the policy is first issued to avoid it if they find a material misrepresentation on your application. You said you were a non-smoker, but you weren't, or you hit a known health issue.
Right, and the Marie example is great for this.
So Marie didn't disclose some old, inconclusive heart issue when she bought her term policy. If the insurer finds out within those first 2 years, they can cancel on her. But after 2 years, the policy becomes legally incontestable.
And if she converts in year 5, they can't suddenly go back and cancel the new permanent policy because of that old issue.
They cannot. The 2-year clock started on the original term policy's date, and it has already expired. She basically immunized her permanent policy by waiting out the contestability period on the term policy first.
That's an incredible benefit. And the same logic applies to the suicide exclusion clause.
Exactly the same. That 2-year clock also starts on the original issue date, not the conversion date.
Okay, the legal stuff is a huge win.
Oh.
Let's talk about the money. How are the new premiums calculated? There are 2 totally different ways. Attained age versus original age.
Attained age is what you'll see almost everywhere. It's simple. The premiums for your new permanent policy are based on your age at the time you convert.
So the longer you wait, the more you pay.
Right. The older you are, the higher the premium. Makes sense. Now, original age conversion. That sounds much better on the surface.
It sounds like a fantastic deal.
It does. With original age, the new premiums are based on the age you were when you first bought the term policy. So let's take Patrick. He bought his policy at age 45. He decides to convert 9 years later at 54.
So with original age, he gets to pay premiums as if he were still 45 for the rest of his life.
Yes, but, and this is the financial elephant in the room you mentioned.
Yeah.
There's a massive lump sum payment required at the time of conversion.
A catch-up payment. Why?
Because you're asking the insurer to pretend you've been paying for expensive permanent insurance for the last 9 years when you were actually paying for cheap term insurance. That lump sum is the difference. It's the cash value that would have built up, or simply the difference in premiums you saved all those years.
So Patrick has to write a huge check to basically buy that lower long-term rate.
A huge check. It's the cost of going back in time, financially.
Yeah.
And because that cost is so high, most insurers either don't offer original age conversion anymore, or they limit it to the first 5 or 10 years of the policy.
Okay, that makes sense. So with all this complexity, when is term insurance actually the right choice?
The guiding principle is actually pretty simple. You should use term insurance for temporary financial risks. Risks that you know will end before you get to, say, age 60 or 70.
If the need for protection is going to last your whole life, you should be looking at permanent insurance from the start.
That's the ideal, yes, even if it costs more upfront. Now, the sources give us 3 really clear, appropriate use cases for term. First, short-term risks with a known end date.
Like a business loan.
Exactly. Felix needs a $100,000 loan for his business. It has to be paid back in 5 years. A 5-year term policy is the perfect most cost-effective way to cover that specific 5-year risk.
The second use case is for decreasing risks.
Think mortgages. Mohammed and Helena have a $600,000 mortgage they plan to pay off in 15 years. A 15-year decreasing term policy is perfect. The death benefit shrinks over time, mirroring their mortgage balance. They don't overpay for coverage they won't need in year 14.
And the last one is probably the most common: limited cash flow.
Oh, absolutely. Think of Angela and Doug. They're in their late 20s, new marriage, new house, new baby, student loans. Money is incredibly tight.
They need a lot of protection, but they can't afford a big permanent policy premium.
Exactly. So term insurance gives them the most coverage for the lowest cost right now.
Okay.
But, and this is critical, they should absolutely get a convertible term policy. That gives them the option to switch to permanent later when their finances are in better shape.
This all ties into that classic advice you always hear: buy term and invest the difference.
VTIID, yeah. It sounds like a brilliant strategy. Take the money you save by buying cheap term instead of expensive permanent and invest it yourself.
But it's not that simple, is it?
It relies on two massive assumptions. First is discipline. If you save, say, $1,500 a year in premiums, you have to actually religiously invest that $1,500 every year for decades.
And life gets in the way. Car repairs, vacations.
Life always gets in the way. The other assumption is investment performance. You're betting your own investment portfolio can outperform the guaranteed internal returns of a permanent life policy over the very long haul. That's not a sure thing.
So at the end of 20 years, you could have no coverage and an empty investment account if you weren't disciplined.
It's a real risk. It works for some people, but it's not the guaranteed strategy that some make it out to be.
You know, reflecting on all of this, the biggest insight for me is that the real value in term insurance isn't just the low price. It's the ability to buy future rights, the right to renew or the right to convert.
That is the whole ball game. And that distinction we talked about, attained age versus original age conversion, it really highlights a strategic choice you have to make from day one.
You have to decide whether to pay a bit more now for that convertible policy to secure the potential for lower fixed rates later on.
Or do you pay the absolute lowest price today and just accept that you might face sticker shock if you try to convert later in life? Or worse, find you're uninsurable because you didn't get a convertible or renewable policy in the first place.
It really raises a fundamental question for you, the listener, to think about.
It does. Are you better off paying for flexibility and risk transfer right now today, making sure all your options stay open no matter what happens to your health? Or are you willing to bet, really bet, on your own future health and your own financial discipline holding strong for decades to come? That is a strategic question worth some serious thought.